Hey guys, welcome back. Legendary value investor Jeremy Grantham is well known for predicting stock market bubbles and stock market crashes. He's recently been showing up on several media channels and being very vocal about a coming stock market crash, comparable to the 1929 and also year 2000 crashes. Unfortunately, there seems to be more and more experts out there coming forward and warning of a stock market crash. So, in this video, we're going to be taking a look at the reasons why Jeremy Grantham believes we're in a stock market bubble, and also that there's a crash coming, and within months, not years. However, don't worry, it's not all about doom and gloom. We will be finishing on a more positive note on where he thinks there is opportunity and some places where we could be putting our money. As always, if you do find anything useful in the video, be sure to drop a like. That would be very much appreciated. Okay, sit back and relax. Here is why Jeremy Grantham believes we are headed for an epic stock market crash. Okay, so here is what we've got coming up. We're first going to take a quick snapshot look at who is Jeremy Grantham. This will give you context so you know who you're actually listening to. He'll then discuss the current situation and the current stock market bubble. He'll then explain how to measure true value, and this is from a legendary value investor, and then finish on a positive and look at where we should be investing right now. First up, who is Jeremy Grantham? Well, like me, he's a fellow British born, currently at 82 years old. He did study in the UK, but then he went on to America, to Harvard, to do his MBA. His net worth is around the $1 billion mark, according to CNBC. He's the co-founder of GMO, which is an asset management company, and he's well known for being a bit of an expert on market bubbles.
We've had even more spectacular Fed friendliness and government friendliness. So we've had, for once, the joining of fiscal spending with the Fed's behavior and the usual moral hazard that has been going on since Greenspan arrived in the 90s. And the result of this is the confidence has risen and risen until finally people are reaching for the greatest demonstration of confidence they have had in their investment career. They're borrowing more money to throw it into the market. Their belief in the market is profound. The common wisdom is that with the Fed on your side, how can you lose? When they first said that back in Greenspan, there were a few doubters. When they said it with Bernanke, there were less doubters, but some. And now finally, there appear to be almost no doubters at all. The belief is more or less complete that all it takes is the Fed on your side and stocks will rise forever.
So, a few interesting points there. He says that this time we don't just have big monetary stimulus, we also have big fiscal stimulus too, creating an obvious moral hazard. He talks about the current narrative is beginning to change, and people's confidence in the market is beginning to grow. Now, with the belief that as long as you have the Fed on your side, then the markets will keep going up and up and up. Trying to predict exactly when the market bubble is going to peak is notoriously difficult. However, sometimes there are telltale signs and some crazy, irrational investor behavior. If you didn't know, Jeremy Grantham was an early investor in QuantumScape, and this is an EV company that recently IPO'd. And he gives an example of this crazy investor behavior. Take a look.
And you need crazy, by the way. That's the best timing for a bubble top, is crazy behavior. My own stock in QuantumScape, it came into the market at 10 and shot up to 130. At 130, it was bigger than General Motors or Panasonic. And this is a brilliant company, but it has no trouble admitting that it won't be producing any batteries for 4 years. So no sales, no profits, and bigger than GM. There is nothing like that in 1929, nothing of that scale, nothing like that in 2000. The Ciscos of the world were pretty serious companies, but they didn't get to this level. 1929, of course, ran into the Great Depression and global trade problems. So you really just want to look at the first leg down, which was big enough. The analogy is much better with 2000. In 2000, it went down 50%. And the reason it only went down 50 and bounced back relatively quickly was because the Fed came charging in to the rescue.
Next up, unfortunately, he mentions that this isn't going to be a small crash, and does make comparisons to the 1929 and also year 2000 bubbles. He also mentions that this next big round of stimulus money that's coming just might make the final peak, which would go down in the history books. But even more important, he mentions that we're only a matter of weeks or months, not years away from this all happening. Take a look.
And I have no doubt some of this new round of stimulus will. And if it's as big as they talk about, this would be a very good making of a top for the market, just of the kind that the history books would enjoy. And we will have a few weeks of extra money and a few weeks of putting your last desperate chips into the game, and then an even more spectacular bust. The market is going to end up, as we know, where it is going to end up. And all the paper in the world will not change the level that is justified by the flow of dividends and earnings. That is, after all, the only thing you can end up eating is the flow of dividends. And sooner or later, the stock market will once again, boring, sell on the future flow of dividends. When you have reached this level of obvious super enthusiasm, the bubble has always, without exception, broken in the next few months, not a few years. It's always. You can't maintain this level of near ecstasy. It can't be done because you've put in your last dollar. You are all in. What are you supposed to do beyond that point? You can't borrow any more money. You can't take any more risk. In fact, you know in your heart of hearts, you have never taken this level of risk and you never thought you would.
So, pretty interesting stuff. Next, being a value investor, he did make some really interesting points on value. More specifically, how to measure true value in a company, which I thought was very interesting and worth including. Today, there are several ratios that investors use to try and assess the company's value. The price to earnings ratio, or PE ratio, the price to book ratio, the price to sales ratio. He goes on to say that these don't actually measure true value, and that there's only one way to measure true value. Take a look.
I have no confidence, and have not had any for over 20 years, in price to book and PE and price to cash flow, price to sales even, as a measure of true value. A measure of true value is the long-term discounted value of a future stream of dividends. A growth stock is, of course, worth a higher ratio of this, that, and the other than a low growth stock. But that doesn't mean they can't be overpriced. So value should be cheap for what you are. You should build in the growth, you should build in the quality, and if it's overpriced, it's overpriced. But to use a simple-minded measure of book is a crazy idea. A cheap book is the market's vote on the worst assets out there in the marketplace. The lowest PE is the market's vote on the worst earnings, most likely to be overstated or downgraded. And the same with yield. It's the market's vote of the most likely to be cut. These have no business being a good indicator of future performance.
And finally, I didn't want this video just to be doom and gloom. I do personally believe there's always opportunity, even in the worst of times. So let's end on a positive note. So let's try to answer the questions. Okay, so what should we be doing with our money? Are there opportunities out there, or should we be just selling everything and moving into cash? Here is what he said.
I suspect selling everything would work out just fine. However, having said that, there are major discrepancies, as there were in 2000, between the US tech, which is overpriced the same as it was in 2000, and everything else. So the value stocks, the low growth stocks, if you prefer it, are about as cheap relative to the high growth stocks as they ever get. So they will not have the same pain, but they're still at risk to some degree, I suspect. The good news is that overseas, they have not had this same huge bull market and the same overpricing that we have had. And that of course, is a heaven-sent opportunity, because you can go out into the emerging markets, and they are absolutely not that expensive, despite the ridiculous argument of comparisons with a overpriced bond market. They're simply not that bad anyway. And compared to the S&P, they're as cheap as they have ever been, about. They've been this cheap 2 or 3 times, and each time it's worked out very well. So you can buy emerging markets, and you can look at the intersection of those two ideas, which is the low growth stocks or the value stocks within emerging, and they are handsomely priced. You should be able to make a really decent 10, 20-year return there. You will not make a handsome 10 or 20-year return from US growth stocks. There is, in the end, a simple arithmetic. The higher you bid up the price of an asset, the lower the long-term return you will get. There is nothing you can do to change that equation. Every day the market goes higher, you know only one thing with certainty, that the long-term return will be less than it was the day before. I also think shares that benefit from the greening of the economy will do much better than the rest. Anything to do with renewable energy, the electrification of the system, electric cars, etc. These are all going to have top-line revenues that dwarf the declining growth rate of the rest of the global economy. It will take trillions of dollars to decarbonize the global system. It will dominate everyone's portfolio. And if you have to own US stocks, they're the ones to own. And look around for a good climate change fund. I'm happy to say GMO has one. And they're doing very well now that the focus is clearly, finally, took 20 years to wake up, but in the last year, people really are beginning to understand the size of the problem and the need to move money into greening the economy.
So, according to Jeremy Grantham, selling everything into cash would probably work out just fine. He does see opportunity in the emerging markets as they haven't had the same bull market and overpricing. They are near to as cheap as they've ever been when compared to the S&P 500. And finally, he does see opportunity in companies that help in greening of the economy. So things like renewable energy, electric vehicles, climate change. So there you are, guys. Unfortunately, yet another expert warning of a stock market bubble ready to pop. I am personally of the opinion that no one really knows when or how severe this is going to be. So it's best to position your portfolio so that you can benefit either way. Is this even possible? Well, for more on that, be sure to check out this video here. And remember, it's not always about doom and gloom. There are opportunities even in the worst of times. And I do think we should always remain optimistic. So, hope you found this useful. In fact, if you did enjoy anything in the video, be sure to drop a like. That would be very much appreciated. If you haven't yet subscribed, then be sure to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.